dear CA, CMA final students. This is a super quick revision video of all the adjustments, of all the major adjustments in consolidation of subsidiaries in days 110. And maybe one day before exam or on exam day, if you can set the speed and watch, you can run through all the adjustments in 15 to 16 minutes. So let's quickly get into the lecture. So, what are the common adjustments? If you get a consolidation question, what are the common adjustments? In most of the questions, the adjustments which you have, if there is revaluation of assets of subsidiary and depreciation effect, what are the treatments? So, treatment is step number 3, identify revaluation profit or loss, which is always by comparing book value on date of acquisition with fair value on date of acquisition. So always remember that book value on the date of acquisition should be compared with fair value on the date of acquisition. Some other dates, closing dates, fair book values are given, means you should go back to the date of acquisition and identify the revaluation profit or loss, which is always what nature? Pre-acquisition nature. Pre-acquisition nature, which is always pre-acquisition nature. Then in step 3 itself, identify depreciation effect. Identify depreciation effect. Depreciation should be always adjusted in post P&L or retained earnings. The effect is always in post P&L or retained earnings. The effect is always in post P&L or retained earnings. Okay, we'll never make a mistake on this because almost all the questions which you have tried is having this adjustment. Maybe chain holding does not have, but all other questions have this adjustment. Okay, and don't forget to give the impact and effect in balance sheet. Also, the effect is in balance sheet. So step 3, balance sheet. Okay. Now, if there is a URP upstream transaction, again, the next common, very common adjustment is URP upstream or downstream transaction. What do you mean by upstream? Up means what? Upstream. Upstream means, yes, subsidiary to parent. Actually, our IND AS 110 is not using this term, but be clear. Subsidiary to parent is upstream. If it is subsidiary to parent, upstream, what are the effects? Step 3, as I said, when nothing is given, post acquisition P&L, deduct URP. Deduct URP. Okay. Now, balance sheet. Balance sheet also, you need to deduct URP. Yes. And what is down? Downstream means parent to subsidiary. Sale by parent to subsidiary is downstream. And if it is downstream, the effect is in step number 8. That is consolidated P&L. Consolidated P&L. Okay. And deduct. There what is to be done? Deduct. So deduct from the profits of the respective companies and also give the effect to balance sheet. Okay, correct. I remember this. I am okay. Now, dividend paid during the year out of post-acquisition profits or pre-acquisition profits. If dividend is paid out of pre-acquisition profits, dividend paid out of pre-acquisition profits. So it is pre-acquisition dividend. If dividend paid out of pre-acquisition profits is pre-acquisition dividend. If paid before date of acquisition, if paid before date of acquisition, deduct from opening profits. Deduct from opening profits. Deduct from opening, because before date of acquisition means already opening profits is reduced. To that extent, before date of acquisition, if it is paid, deduct from opening profits. But after date of acquisition, don't deduct from opening. Don't deduct from opening. Okay, instead, don't deduct from opening. Instead, add back to post-acquisition profits. Add back to post-acquisition profits. Yes or no? Add back to post-acquisition profits. Yes. Yes, 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 yes. So simultaneously, you should process, you should think. Yeah, correct. Correct. Now, bonus issue. Next common adjustment, bonus issue. Bonus issue made out of pre-acquisition profits. No impact. Bonus issue made out of no impact in consolidated balance sheet. Whether you deduct or don't not deduct, because the effect is in pre-acquisition profits and share capital. What is the only impact of pre-acquisition profits and share capital? We take it for opening NCI and balance sheet. So if there is bonus issue out of pre-acquisition, profits will reduce, share capital will increase. So net effect is same. Yes or no? So no impact in consolidated balance sheet. Out of post-acquisition profits, deduct from post profits, deduct from post acquisition profits. So post acquisition profits is reduced. So definitely there will be impact. Deduct from post acquisition profits, share capital of subsidiary will increase. Effect in, there will be naturally in the corresponding effect. Your NCI will change, your post-acquisition profits will change. So, of course, there will be impact. Okay. If question says post-acquisition profits, then post-acquisition profits will be having a balance, അല്ലേ? Unless otherwise specified, ഇങ്ങനൊരു adjustment rare ആണ്. Unless otherwise specified, bonus issue is always out of pre. And that is what correct also. Bonus issue, current year bonus issue, you cannot make out of current year profits. When this company go for bonus issue, when they have accumulated profits. So what is technically, practically correct is taking from pre. See, in case if you get a question out of post, deduct it from post. That's it. Okay. So post is not sufficient. Question says take it from post and one post is sufficient. Post cannot be insufficient if the question says post. Okay. Now, investments in preference shares of subsidiary. Preference shares, holding companies having investments in preference shares of subsidiary. If preference shares is treated as equity, cancel investment value. Against, cancel investment value against preference share capital. Preference share capital. Gain or loss. Goodwill or capital reserve. Oh, that is preference share capital to that extent will be cancelled. Investment value will be cancelled. Gain or loss should be recognized as goodwill or capital reserve. Okay. If it is treated as liability, if nothing is mentioned in the question, preference shares are always assumed as liability. Treated as liability, yes. Just like mutual owing, cancel and gain or loss if in case gain or loss is adjusted in step number 8. Consolidated P&L will be adjusted in consolidated P&L. Oh, liability gain or loss in P&L. Equity gain or loss is considered as goodwill or capital reserve. Did you get that? Yes. Then mutual owings, like any other mutual owings, cancel. Gain or loss, if any. Gain or loss, if any, to gain or loss, if any, to statement of P&L. Yes. Now, very common impairment of goodwill. What if there is impairment of goodwill? Impairment of goodwill. Full goodwill impaired? Full goodwill impaired. So, goodwill is deducted first. Okay. Goodwill in consolidated balance sheet will reduce. Yeah, that is correct. And loss is adjusted to parent consolidated P&L. Loss is adjusted to consolidated P&L and NCI. Loss will be borne by NCI and parent. Okay. Partial goodwill. Loss is borne by parent. Loss is borne by parent. To come, see, sometimes they will give you this is the impairment of goodwill. This is the amount impaired. Then there is no problem. Then loss is borne by parent. Only step 8 consolidated P&L will be reduced. But if the question says asking you to calculate impairment, if it is partial goodwill and the question is asking you to calculate impairment loss. So impairment loss given or impairment loss is asked to be calculated by you. Then if it is partial goodwill, grossing up of goodwill, notional goodwill raised that we tried yesterday. Yes or no? We are getting that. Ah, yes. That kind of feeling. Do you have that November 23 RTP question? Grossing up. Yesterday's goodwill was 2,07,200. Divide by 18 to 100. Very important adjustment. Very important question. Yes. Now, ah, at that, okay. If the question asks me to calculate, I need to gross up and calculate. But loss will be adjusted only to parent. Okay. 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 Now, unaccounted income and expense. If there is an unaccounted income and expense for subsidiary, step 3 to post. If nothing is given, unaccounted will be post acquisition. Pre-acquisition still unaccounted will not be there. Post acquisition. Parent unaccounted in step number 8. Unaccounted interest, unaccounted preference dividend. Do you remember? Yes, 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 yes. Now our chain holding, which we did just now, chain holding, consolidating subsidiary. So what are my steps? Compute the effective shareholding. The one which we did just now, compute the effective shareholding in step number 2. Compute effective shareholding in step number 2. And allocate the cost of investment. Here in that problem 280 we allocated to parent and subsidiary in 80:20 ratio. Yes. So allocate cost of investment in the books of subsidiary company to parent and NCI in their respective shareholding. Are you clear? Yes, we are. It is just now we did. So there is no way to forget. We remember this. Great. Now we have not seen this. Yeah. Just we can quickly run through. That is uniform accounting policies. While preparing consolidated financial statements, both parent and subsidiary should follow uniform accounting policies for like transactions and events of similar nature and circumstances. While preparing CFS, parent is following one accounting policy, subsidiary is following another accounting policy that is not permitted. For same type of inventory, parent and subsidiary dealing in same business. Parent is following FIFO, subsidiary is following weighted average cost. It is not permitted. Subsidiary should follow the accounting policy which is followed by the parent. Okay. But in case if they are in totally different lines of business, if they are in totally different lines of business, if the different accounting policy can be justified. If transactions are clearly different, that is what, see, I want you to learn this line at least in CFS. Okay, in CFS, both parent and subsidiary should follow uniform accounting policies for, what is the next line? Like transactions and events of similar nature and circumstances. If the transactions are and events are clearly distinguishable, different, then no need to follow uniform accounting policies. Are you okay? Yes. Yeah. Then different reporting dates. See, CFS should be prepared for the same reporting date. Financial statements of parent and financial statements of subsidiary should end on the same date. 31st March is the reporting date of parent. 31st December is the reporting date of subsidiary. Now we'll ask subsidiary. Subsidiary, please prepare the financial statements on the same reporting date as of the parent. Okay. So if different, then subsidiary should prepare the financial statements ending the same reporting date. Okay. Reporting date. If it is impracticable to do so, if it is impracticable for the subsidiary to do so, then significant transactions and events should be adjusted till the same date. Then you should prepare consolidated financial statements by year ending 31st March 2025 for parent, 31st December 2024 for subsidiary. In such case, if it is not the same date but significant events are adjusted, in such case the difference in the financial in that reporting date should not exceed 3 months, 3 months. Okay. Now quickly see these areas. With that, we are not closing. In the associate them, I need to try one small question. With that, we'll close. So please listen. Disposal, it's not disposal. Acquisition of share after obtaining control. You already had 70% of share, but now you acquired 20% of share. So you got 90% now. So when IND AS 103 applies in your book, 103 applies in your book, will 103 apply twice in your books at the time of 70% and at the time of 90%? No. 103 applies only when you acquire control 70%. First time, 70%. Okay. So if it was like this, already I had 40, then I acquired 30, then I acquired 20. Still on this date, control acquisition, correct. Only the date when control is acquired. So cumulatively it is 70. So this date only the standard applies. I understand. Now you acquire further 20, 110 will take care, and 110 has taken it very easily. The accounting is very easy. In AS 21 starting, നമുക്ക് കുറേ additional steps ഉണ്ട്. There are so many steps to do, but IND AS has made our life very simple. Acquisition of share after obtaining control. The entry is 70 has become 90, means my NCA has reduced to 10%. Yes or no? My original NCA 30 has become 10%. So what is the entry? Tomorrow if you get a 4 marks, 5 marks question, What is the entry? NCI debit with proportionate share. If NCI was 30, now NCI is 10. So NCI balance was 1500 before. On the acquisition of further 20%, on that date NCI was 1500. 1500 was for 30. Now 20 is what reduced. So 1500 divided by 30 into 20. Debit 1000. NCI's share of 1000 is reduced. How much did you pay for this? I paid 900, then gain. I paid more than 1000, then loss. Are you following? Hmm? And why not debit investment? Ah, okay, okay. Yes. See, our entire discussion is on preparing what? Okay. In separate financial statements, it will be investment to bank. No doubt. In consolidated financial statements, there is no investment in consolidated financial statements. Yes or no? So it is NCI to bank. And if there is a gain or loss in consolidated balance sheet, if there is a gain or loss before control, after control, then gain or loss is to other equity. Don't take it to P&L. Before the acquisition, you had control. Yes. After this transaction also you have control. Yes. Then gain or loss should be transferred to other equity, other equity, other equity. Okay, okay, okay. So, see, you may get a 4 marks question on this. Be clear. Okay. Then, what if the otherwise? Disposal of shares in subsidiary. Disposal of shares in subsidiary. Complete disposal of shares in subsidiary. What are the adjustments if there is complete disposal? What are the adjustments if there is complete disposal of shares in subsidiary? If there is complete disposal, bank debit with the consideration. Okay. NCI debit, book value. 2. Goodwill credit, book value. 2. Net assets credit, book value. Gain or loss 2. Before control, after no control, then gain or loss to P&L. Okay. Gain or loss to P&L. Okay. Now, very, very important point. Any amount of OCI recognized in consolidated financial statements. Of course, subsidiaries OCI's share will be added to parent company. Yes or no? If subsidiary had a OCI share of that 80% or 90% is parent's share. So that we would have added to the parent company's reserves. See, in our consolidation questions, it's always general reserve, P&L, retained earnings reserves, that's it. But what if it is an OCI item? Then I'll take again 90%. Are you understanding? What am I telling now? See, subsidiaries OCI, if you have 80% in subsidiary, subsidiaries OCI is 80% will appear in your books. So, amount of OCI recognized in consolidated financial statements is required to be reclassified. Is required to be reclassified to either P&L or retained earnings as the case may be. It can either be to retained earnings or to P&L as the case may be. Are you okay? It's easy, right? See, if it is complete disposal, it's just opposite of um, consolidation. At the time of business combination, I pass the journal entry net assets debit, goodwill debit to NCI to bank. Yes or no, guys? Come on. That is the entry we had passed in business combination. Yes. So same thing, just reverse. What if it is partial disposal with loss of control with not loss of control. Partial disposal with loss of control, without loss of control. I'll fill without loss of control. Without loss of control. Partial disposal without. I had 90%, I just sold 10%. Then what will be the entry? Very good. Bank account debit. I got money to NCI. NCI's share will increase proportionately. Gain or loss to? Can you tell me gain or loss to? Gain or loss to?
OCI.
OCI ആണോ gain or loss to? Other equity.
Sorry, OE.
Yeah, other equity. That is before control and after control. Gain or loss should be transferred to other equity. Other equity. Other equity. Okay. Now, if partial disposal with the loss of control, partial disposal with the loss of control, then uh, same as complete disposal. But there is a difference. Eh? You said same. Yeah, only thing. New that remaining investment should be recorded at fair value. That is, my entry will be bank debit, NCI debit, investment debit. Oh, this investment should be recorded at fair value. To goodwill, to net assets. Here gain or loss to P&L, correct. SOPL, statement of P&L. Okay, yeah, understood. Now we have an associate question which I want to try. Okay, can I close this? Now I want this one also. It actually in the book no, but I want to do this one also. Accounting for change in investment entity. Did you study anything with regard to investment entity? What is an investment entity? An entity which is engaged in investments and um, giving the returns to the original investors, that unit holders will distribute. The entity which is engaged in investments. So investment entity, what have you studied? Investment entities are not required to prepare consolidated financial statements. What we have studied with regard to investment entity is not required to prepare consolidated financial statements. So the area is, what if a investment entity, it was originally an investment entity. Investment entity had in A Limited, investment entity had investment of 60%. But no need to prepare CFS. No need to prepare CFS. No need to prepare CFS. Okay, no need to prepare CFS. I know that. But on say 30th June 2025, investment was measured at FVTPL. Correct. Investment was measured as FVTPL. Investment entities will measure investment as FVTPL. Now, on 30th June 2025, it changed the status of investment entity. It changed the status of investment entity. Then it becomes a parent company. Parent company having investments in A Limited 60%. Then what you should do? So on 30th June 2025, on the date of change in status, IND AS 103 will apply. Okay, IND AS 103 will apply. IND AS 103 will apply. Are you understanding? Because control is obtained on 30th June 2025. Till yesterday, the intention was not control. Are you clear? The intention was not control. Yes. So there is a, I don't know, but still, let me read that 35 and 36 are the last two questions. I'll just quickly, either you just need to be careful now, just listen, just other kind of you leave it because it is that simple. A Limited ceased to be an investment entity from 1st April. Oh, changing status on 1st April. On which date it was holding 80% of B. Okay. The carrying value of investment, which was measured as FVTPL, originally it was FVTPL, 4 lakhs. The fair value of NCI on the date of status is 1 lakh. The value of subsidiaries net identifiable assets is 4 lakh 50, which means 103 is applying. So 103 says 80% investment means find out PC, find out net identifiable assets, find out NCI and account. Goodwill or bargain purchase gain and account. So here how will I account? So on the date of change in status, FVTPL investment which is measured at FVTPL is 4 lakhs. Today if you want to acquire the investment it is 4 lakhs. Yes or no? So that will be considered as the deemed consideration. Either investment is appearing at 4 lakhs means investment value is the purchase consideration. Otherwise also SFS investment value is the purchase consideration. Yes. So that 4 lakhs will be considered as purchase consideration. Now NCI fair value is given 1 lakh. Net identifiable assets is 4 lakh 50,000. So we'll take deemed PC 4 lakhs. Fair value of NCI 1 lakh. So total 5 lakhs. Net identifiable assets 4 lakh 50, resulting in a goodwill of 50,000. So now it is required to prepare CFS. In CFS, net identifiable assets debit. Are you with me? Net identifiable assets debit. Net identifiable assets debit 4 lakh 50,000. Goodwill debit 50,000 to investment, but there is no PC. But investment I'm cancelling. That investment value is the deemed PC. 4 lakhs to NCI 1 lakh. Did you get this? Are you clear? ഇത് മനസ്സിലായോ? Yes. പിന്നെ? Yes. Now, then ulta. What ulta? That is, it was parent till yesterday. It was a parent entity. Parent entity had 60% in subsidiary, but parent has changed the status to an investment entity on 30th June 2025. Then what is to be done? You can predict, you can guess and say what the treatment is. No CFS. It is like disposal journal entries. No CFS. So what should be the journal entry? What should be the journal entry? Can you please guess? And your guesswork will be correct. What will be the journal entry? Okay. Journal entry is bank debit വരില്ല. Investment debit. You debit investment at fair value. Cancel NCI if you have. Cancel goodwill if you have. Cancel net assets. Derecognize. Your goodwill credit. Credit. Gain or loss to P&L. Are you guys clear? This point, is it okay? Yes. So that for that one also there is an example. So I think you're all following the last question. CD purchased 100% subsidiary. Oh, you had a 100% subsidiary, 2 lakhs. when the fair value of net assets is 16 lakhs. So 20 lakhs, 20 lakhs subsidiary. 20 lakhs is the PC you have given. Net assets is 16 lakhs. Therefore, goodwill is 4 lakhs. Okay. CD becomes an investment entity. Oh, till yesterday it was a parent, but now an investment entity. And the carrying value of investment measured at FVTPL. Now investment should be valued at 25 lakhs fair value. And carrying value of net assets excluding goodwill is 19 lakhs. Other net assets 19 lakhs. So now investment value is 25 lakhs. Other net assets is 19 lakhs. So what will be the journal entry? Investment debit 25 lakhs. There was no NCI. Goodwill 4 lakhs. Other net assets 19 lakhs. So it is resulting in a gain of 2 lakhs. Am I correct? Yes. So consolidation, as I always say, you should try questions. Then only you will get a grip over it. Just seeing it, reading through, going through will not work. You should try. That we know. Okay.